Chapter 10. Before we start, smash subscribe and like and share. To see more content like this. Fundamental analysis. Fundamental announcements analysis. Countries are managed, to a large degree, like companies. Some countries have a single leader they call a president, prime minister or king, much like the CEO, chief executive officer, president or managing director of a company. Other countries have a ruling body called a House of Commons, a Senate or a Congress, much like a corporation's board of directors. Countries produce goods or services for consumption and so do companies, see Figure 10.1. Companies issue stock certificates enabling individuals outside the original founders to participate in its growth and financial benefits, just as countries do with their currency. The currency you carry around or place in a savings account is your stock certificate or part ownership of that country. If a company grows, as a rule, the stock certificate increases in value. If the company incurs too much debt, has a bad year or two, or ends up with bad leadership, the share value decreases. A country is the same. If the country grows economically in comparison with other countries around the world, the value of its currency will grow in proportion to the devaluation of another country's currency. If you have acquired a sufficient amount of currency from a particular country, whether it be by inheritance or by hard work, you may choose to keep it in that country. If you are educated about the world economy, you may prefer the economic stability of another country versus the one you live in and choose to save your money elsewhere. For example, let's say you live in Venezuela and do not feel safe with the way the leader is running the country, but you feel fairly secure about America. You may earn your money in Venezuela but save it in America by converting your bolivars into US dollars. What happens to the value of a stock when earnings did not meet expectations, or an officer is caught stealing from the company, or the president sells 80% of his shares or holdings in the company? The value of the company share goes down. Investors start to believe that management is not keeping its eye on the ball, they become insecure about the company as a whole, and they begin to sell their stock. When more people sell shares of a company versus buying shares, the value of the share goes down. Conversely, what happens if a company announces that it has created a revolutionary product and will need to increase its employees by 20%? Investors may get excited and start a buying frenzy of the company stocks and drive the share value up. The news that comes out about a company, good or bad, is called a fundamental announcement. Countries and companies both have fundamental announcements, which have similar effects on the value of a country's currency as it will have on a company's share price. The same effect that unemployment at an all-time high or housing starts at an all-time low have on currency values is similar to what happens if the prime minister resigns or if the married president is caught cheating on his wife with an intern. Bad news like this drives down the value of the currency. People get nervous and feel the leadership is in disarray and may move their money out of the country and into another country in hopes of preserving the value of their estate. When investors get nervous, for whatever reason, and want to move their money from one country to another, it is called fleeing to safety. They move their money from one country to another, creating a buying frenzy around the currency they are acquiring, driving the value up, and creating a selling frenzy around the currency they are selling, which drives the value of that currency down. If the masses start selling more than buying stock or currency, it will drive prices down. Selling US dollars and converting them to Japanese yen will drive the value of the US dollar down and the Japanese yen up. America declares war on Iraq. Investors know a war will create hardship for the country, its leadership, and its people. Employment may go down due to a weakened economy during wartime. If the country gets into trouble fighting the war and needs to borrow money to continue, other countries may be hesitant to lend it money because the enemy might win, take over the country, and make it more difficult for the borrower to pay the loan back. That being the case, the country becomes a high-risk borrower and must pay a higher interest rate, which increases its debt, to acquire the funds it needs. If leadership, the economy, and the war start to get out of hand, investors may get nervous about leaving their money in, for example, America and want to move it to perhaps a country like Great Britain. If a lot of investors feel that way, they will flee to safety and start selling their US dollars and buying British pounds. As a result, this will drive the US dollar down in value and the British pound up. Just as every public corporation has a set of announcements that inform investors about the overall health and well-being of the company, so do countries have similar announcements. In both cases, the announcements allow investors to either buy more stock or currency, sell what they have, or stay neutral. These announcements are fundamental announcements. In the currency market or on the Forex, each country around the world has approximately 20 major fundamental announcements annually for investors to monitor. The importance of the announcements shifts as the economy shifts. Governments report the health and overall economic well-being of a country to investors via fundamental announcements, which are the economic indicators of the country. Even though most economic reports are created monthly, quarterly, and yearly, some are created weekly. Some economic indicators or reports carry more weight than others. Some examples of such economic reports are the gross domestic product, GDP, employment and non-farm payroll. Investors should watch the monthly, quarterly, and yearly economic reports, but the weekly versions of the same report are of less importance. All economic reports are posted on a governmental calendar, giving the date, time, and the forecast or expectation of change, as well as the previous percentage change. See Figure 10.2. You can keep up with all major government reports that affect the Forex at www.markettraders.com or www.forextips.com, under the heading Economic Reports, or in leading newspapers such as the Wall Street Journal, the Financial Times, or the New York Times. Although newspapers are great resources for information on fundamental announcements, the Internet is now the #1 source for investors. When a fundamental announcement is about to occur, investors usually stop buying or selling right before the announcement. If the news is good, prices may go up, and if it is bad, prices may go down. Either way, to play it safe, they usually wait until the announcement is read before they take a position in the market. Within seconds after the announcement is read, a frenzy of buying or selling starts to take place, potentially creating a dramatic price change in only a couple of seconds. Let us say you are trading and waiting for Mr. Ben Bernanke, chairman of the Federal Reserve Bank of the United States, to announce a potential U.S. interest rate change at 2:30 p.m. Eastern Standard Time, approximately 10 hours from now. The current interest rate is at 4.5%. There are 3 possible scenarios that could result from the announcement. The interest rate could go up, it could go down, or it could remain unchanged. Let us look at possible cause and effect scenarios. Cause: interest rates go up, and as a result the cost to borrow money increases. When the cost of borrowing money goes up, fewer people will be interested in borrowing money. Effect: the demand for US dollars will go down, and fewer people will buy the US dollar, creating a weaker dollar. Cause: interest rates go down, meaning the cost to borrow money will decline. When the cost of borrowing money goes down, more people will be interested in borrowing money. Effect: the demand for US dollars rises, and more people buy the US dollar, creating a stronger dollar. Cause: interest rates go unchanged. Effect: the value of the US dollar should not change and remains the same. If interest rates increase or decrease, currency values increase or decrease. If you watch the economic indicators of the world and try to trade making money off the rate of change, you are considered a fundamentalist trader. If you trade or take positions based on reading a chart, which I have been teaching you, you are called a technical trader. Technical analysis is the study of chart reading. To be a good trader, you need to create a balance between the technical and the fundamentals. However, the most successful traders of the world are predominantly technical traders rather than fundamentals traders. I will never forget back in the early 2000s, a neighbor of mine gave me a call one morning to say, "Jared, I really need your help." I said, "I will try my best." "What is your situation?" He said, "I own about $300,000 in Microsoft stock. It had a value at one time of about $500,000 and is down to about $300,000, and I don't want it to fall any further." I said, "I don't blame you. Now let me ask you this, are you calling because you think I can increase its value for you?" "I am the FXCHAF, not the STOCKCHAF, you know," I told him, laughing. Then, with a serious voice, he said, "As you know, the US government sued Microsoft for violating monopoly laws and the judge is going to rule Monday morning on the issue." He continued, "Can I get you to look at a Microsoft chart ASAP and help me out here?" I asked, "What do you want to know?" He said, "Can you tell me whether I should sell all my stock today or hold on to it?" I said, "Are you kidding me? This is a no-win situation. If I advise you incorrectly, you will burn my house down. And if I'm correct, you will ignore me as you drive by my house on your way to dinner in your new Mercedes." We both laughed again, and I said, "Give me a minute and I will pull up a chart on Microsoft." Now, as I was pulling up the chart, I was thinking to myself, here is a person investing $300,000 to $500,000 in one stock, who knows what all his holdings are, yet he won't even take the time to educate to himself on how the markets work technically. After all, he openly admitted he was down $200,000 from $500,000. I thought, a simple little lesson on trendlines, trendline breaks, and buy and sell zones could have saved him $200,000. After looking at the chart, I said, here is what I think. The judge is going to rule in favor of Microsoft on Monday morning. He said, "You're kidding, right?" I said, "Maybe yes, maybe no." He said, "Come on. Get serious here and help me out. You know what you are doing and I don't." I said, "Look here, Ken, this is my analysis. The reason I said the judge is going to rule in favor of Microsoft is, technically, the Microsoft chart has been in a downtrend, it has broken the downtrend line, entered into the buy zone, returned to resistance, and is now forming up A, B, C, Ds and is at an 0.618 Fibonacci retracement level / up C and a beautiful morning star has just formed." He said, "Alrighty then," with a hint of sarcasm. "Look Jared, that is all Greek to me. But what I think you are saying is that you want me to hold my position?" I said, "No, that is not what I am saying." "So you want me to dump everything today?" he asked in a voice of frustration. I quickly responded, "No, that is not what I said either." He then yelled at me, screaming, "What should I do? I can't afford to lose any more money." Eventually, I calmly said, "The reason I am so adamant that the judge will rule in favor of Microsoft is that I believe, in situations like this, nature knows ahead of time what needs to happen to keep everything in balance. The charts predominantly tell the trader ahead of time what is going to happen next in the market." He interrupted me, saying, "Really?" As if I was smoking dope. I went on, "Be that as it may, tornadoes can come out of nowhere." I went on, saying, "Here is what I would do. As I said, it is my analysis that Microsoft is going to rally after the judge announces his verdict. So I would stay in my position today, but tell your broker you want to put in a stop order at around $2 a share lower than where it is trading today. I would then dump half of the shares there and keep the other half as a long-term investment, as we both know Microsoft is not going out of business anytime soon." Well, to his surprise, but not mine, the charts were right. The judge ruled in favor of Microsoft and the stock rallied like a rocket. He went to dinner in his new Mercedes while I stayed home. I haven't heard from him since. Trading days versus trending days. Trading days are when there are no fundamental announcements. Currency charts move typically 60 to 90 pips, and sometimes 120 pips, depending on the currency. Trending days are fundamental announcement days, when the market will generally take off in a direction after the announcement and move 120 to 240 pips within the first 5 hours, incurring a major price change. It then often stays at that new price for the remainder of the day. Novice traders prefer trading days as the market is typically more predictable. Expert traders, however, prefer trending days over trading days because you can make more money in less time. If there is a major change, or a major projected change, anticipated in the economy, with the impact of an economic fundamental announcement, the prices will move, see figure 10.3. Before the announcement, traders stop trading, and the chart begins to consolidate. Consolidation, or bracketing, in a chart is a potential sign that a fundamental announcement is about to take place. Traders are waiting for the announcement before taking any new positions. trading appears to be thin, or what is also referred to as light. After the announcement, if there is a percentage change from the previous report, there will be a breakout from that consolidation, as you see in Figure 10.3. After the announcement, traders aggressively start buying or selling, which creates a breakout. In this particular chart, a buying frenzy ensued and prices broke out to the north. In the event of no change after the announcement, the chart will usually continue in the direction of the previous trend. Increased risk with trading fundamental announcements. Traders must be very careful if they want to trade during fundamental announcements. Years back, Forex brokers allowed traders to straddle the consolidation, which means you place a buy above the consolidation and a sell below the consolidation, right before the announcement. When the market broke out, it would automatically take you with it, in the direction of the breakout. Brokers ended up losing a lot of money to traders through this process, due to their inability to offset the trades fast enough in the interbank market. They have now pretty much eliminated the practice of straddling. Today, if you want to trade a fundamental announcement, you either need to be in the market before the announcement or try to get a fill right after the announcement. When trying to get a fill right after the announcement, you risk the danger of being slipped perhaps 30 to 100 pips, as the market rapidly moves in a direction. There have been times, and will continue to be times, when the market moves 200 pips inside of 20 seconds after an announcement. Fundamental announcements can be very volatile and create whiplashes, as seen in figures 10.4 and 10.5, resulting in heavy losses. World economies. There are three major world economies and time zones that traders monitor. 1. The Asian market. 2. The European market, which consists mainly of Great Britain. 3. The US market. The majority of Forex trading transactions are done in Great Britain. More than 75% of all Forex transactions are done during the trading session of the European market. The majority of the $1.5 trillion US dollars of transactions daily are done within the 7 major world currencies. Small retail traders trade the 6 major world currencies Euro, GBP, CHF, JPY, CAD, and AUD against the US dollar. However, most are paid in US dollars. The sun doesn't set on the financial markets of the world. As a matter of fact, the sun never sets, the world continually turns. As the world turns, the financial markets of the world open and close. Somewhere in this world, a financial market is open during any given 24-hour period. At 7 p.m. Eastern Standard Time, the Asian markets open, 8 a.m. local Asian time, and continue for approximately 8 hours. At 3 a.m. Eastern Standard Time, the European markets open, 8 a.m. local British time, and continue for approximately 8 hours. At 8 a.m. Eastern Standard Time, the American markets open and continue for 8 hours. You can see that the three markets overlap each other, although the majority of volume is traded during the European and US sessions. That is where you will find the majority of price movement during any given 24-hour period. If you have an interest in trading what are called off currencies, or currencies other than the majors, you may want to monitor the particular country's economic calendar. For example, if you want to trade the Australian dollar against the New Zealand dollar, you may want to do some research on the major announcements that could affect those two currencies. Keep in mind that the importance of the announcements may change from time to time. If the economy of the country is really suffering, retail sales will play an important role and may be an indicator of potential major change. That specific announcement may create a very volatile currency market during their struggling economic times. However, if the economy is good, retail sales may not have much of an effect at all on price change, regardless of the percentage change in the report. The importance of fundamental announcements. Fundamental announcements have an effect on every country's currency in some way, either immediately or soon after. The Reserve Bank of every country monitors the inflation of the country by using economic indicators. When these reflect inflationary pressure, the bank will generally increase interest rates. When signs of deflation are present, interest rates are generally lowered. Interest rates are important for the economy because they influence the willingness of individuals and households to borrow money and make investments. An increase in interest rates will cause a downturn in the economy, whereas a decrease will stimulate the economic growth. The 13 most important U.S. fundamental announcements. The following are fundamentals announced in the United States. Purchasing Managers Index, Chicago PMI. This announcement is based on surveys of more than 200 purchasing managers in the manufacturing industry who are based in the Chicago area. This distribution of manufacturing firms mirrors the national distribution in the United States. Readings above 50% indicate an expanding factory sector, whereas values below 50% are indicative of contraction. This announcement is made on the last business day of every month at 10 a.m. Eastern Standard Time. Consumer Confidence Index, CCI. This is a survey of 5,000 consumers monitoring their attitudes toward the current situation and expectations regarding economic conditions. This report can occasionally be helpful in predicting sudden shifts in the economy. It can also give a trader an idea about the direction of the U.S. economy. Only index changes of at least 5 points should be considered significant. The announcement is made on the last Tuesday of every month at 10 a.m. Eastern Standard Time. Consumer Price Index, CPI. CPI measures the change in price of a representative basket of goods and services, such as food, energy, housing, clothing, transportation, medical care, entertainment, and education. It is also known as the Cost of Living Index. It is important because it excludes food and energy prices for its monthly stability, referred to as the core CPI, and gives a clearer picture of the underlying inflation trend. This announcement is made around the 13th of every month at 8:30 a.m. Eastern Standard Time. Durable Goods Orders. The official name of this announcement is the Advance Report on Durable Goods Manufacturers, Shipments and Orders. It is a government index that reflects the dollar volume of orders, shipments, and unfilled orders of durable goods. Durable goods are new or used items with a normal life expectancy of 3 years or more. This generally excludes defense and transportation orders because of their volatility. This report gives the trader information on the strength of demand for U.S. manufactured durable goods from both domestic and foreign sources. An increase in the index suggests that demand is strengthening, which may result in rising production and employment. A falling index obviously indicates the opposite. The data is released around the 26th of every month at 8:30 a.m. Eastern Standard Time. Employment situation. This report lists the number of payroll jobs at all non-farm business establishments and government agencies. The unemployment rate, average hourly and weekly earnings, and the length of the average workweek are all listed in this report. This release is the single most closely watched economic statistic because of its timelines, accuracy, and its importance as an indicator of economic activity. It plays a big role in influencing financial market psychology during the month. Non-farm payroll indicator. This fundamental is a coincident indicator of economic growth. The greater the increase in employment figures, the faster the total economy will grow. An increasing unemployment rate is associated with a contracting economy and declining interest rates. A decreasing unemployment rate is associated with an expanding economy and potentially increasing interest rates. The fear is that wages will rise if the unemployment rate becomes too low and workers are hard to find. The economy is considered to be at full employment when unemployment is between 5.5 and 6%. The data is released on the first Friday of every month at 8:30 a.m. Eastern Standard Time. Existing home sales. This report measures the selling rate of pre-owned houses and is considered a decent indicator of activity in the housing sector. It provides a gauge of not only the demand for housing but also the economic momentum. People have to be financially confident in order to buy a house. The data is announced on the 25th of every month at 10 a.m. Eastern Standard Time. Gross Domestic Product, GDP. GDP measures the dollar value of goods and services produced within the borders of the United States, regardless of who owns the assets or the nationality of the labor used in producing that output. This is the most comprehensive measure of the performance of the U.S. economy. Healthy GDP growth is between 2.0 and 2.5%, when the unemployment rate is between 5.5 and 6%. A higher GDP growth leads to accelerating inflation, and lower growth indicates a weak economy. This data is released in the third or fourth week of every month at 8:30 a.m. Eastern Standard Time. New home sales. This report is based on interviews with approximately 10,000 builders, or owners of about 15,000 selected building projects. It measures the number of newly constructed homes with a committed sale during the month. It is considered an indication of near-term spending for housing-related items and of consumer spending in general. However, investors prefer the existing home sales report, which accounts for around 84% of all houses sold earlier in the month. Philadelphia Fed. This is a regional manufacturing index that covers Pennsylvania, New Jersey, and Delaware, which represents a reasonable cross-section of national manufacturing activities. Readings above 50% indicate an expanding factory sector, whereas values below 50% indicate contraction. The data is released on the third Thursday of every month at 10 a.m. Eastern Standard Time. Producer Price Index, PPI. The PPI measures the average price of a fixed basket of capital and consumer goods at the wholesale level, which gives a clearer indication of the underlying inflation trend. There are three primary publication structures for the PPI: industry, commodity, and stage of processing. It's important to monitor the PPI excluding food and energy prices for its monthly stability. This announcement is made around the 11th of every month at 8:30 a.m. Eastern Standard Time. Retail sales. This index measures the total sales of goods by all retail establishments in the United States. Sales of services are not included. These figures are in current dollars, which means they are not adjusted for inflation. However, the data is adjusted for seasonal, holiday, and trading day differences between months of the year. The retail sales index is considered the timeliest indicator of broad consumer spending patterns, providing a sense of the trends among different types of retailers. These trends can help you spot specific investment opportunities. The data is released around the 12th of every month at 8:30 a.m. Eastern Standard Time. International trade. This report measures the difference between exports and imports of U.S. goods and services. Imports and exports are important components of aggregate economic activity, representing approximately 14% and 12% of the GDP, respectively. Typically, stronger exports are bullish for the dollar. The data is announced on the 19th of every month at 8:30 a.m. Eastern Standard Time. The above economic indicators are the most relevant for the 6 major world currencies on the Forex market, but that does not mean they are the only ones. Once again, you can keep up with all major government reports that affect the Forex at www.markettraders.com or www.forextips.com, under the heading Economic Reports. I strongly suggest you review the economic calendar daily before you trade in order to be prepared for any surprise movements in the market. Conclusion. Tracking down the fundamental announcements before you trade is critical. Make it a habit to see if there are any major fundamental announcements about to take place, which may create volatility. Trading during fundamental announcements can be like riding the rapids in a river, whereas trading during non-fundamental days can be like riding in the calm part of the river. I recommend that the novice trader shy away from trading during potentially volatile times, staying focused on only trading what you understand. Do not ever trade with a sense of false security, thinking that the environment is going to be calm because you checked with the economic calendar and there were no announcements. All it takes is an attempted assassination of a president, an unscheduled announcement of an interest rate change, or a September 11th type event, and that calm trading environment will suddenly turn hostile and volatile. Whenever an unexpected announcement or event takes place, it can have a major impact on prices in the market. Don't forget to smash subscribe and like and share to see more content like this. See you next chapter. Much love.